All right, let's get right into this explainer. We're looking at a wild scenario today. What exactly happens when the notoriously volatile world of crypto mining collides head-on with the booming enterprise AI sector? Well, a major Bitcoin miner just struck an absolutely massive deal with one of the hottest AI companies on the planet. And the market's reaction? Their stock just went on a tear, soaring 25% in a single session. We are literally watching an unprecedented convergence of two massive industries right before our eyes.
So, naturally, we really have to ask ourselves here, is this massive pivot to AI infrastructure a permanent re-rating for Riot Platforms, or is the market just getting dangerously ahead of itself? Because, let's be real, when a deal of this magnitude drops, the initial hype can absolutely mask the brutal operational realities underneath. Let's find out.
To get to the bottom of this, here's our roadmap for this explainer. We'll start with that jaw-dropping $9 billion deal, unpack the latest Q2 financials, and look at the market reaction and analyst views. Then, we'll zoom out to the broader AI infrastructure boom, break down the major risks and headwinds, and wrap up with the key milestones you need to be watching.
All right, kicking things off with Section 1, the $9 billion deal and Riot's massive 20-year agreement. And guys, the numbers on this one are absolutely staggering.
Get this, that $9.1 billion figure? That is just the base value for this 20-year cloud computing deal. If things go smoothly, that number could actually balloon to a massive $16.1 billion, assuming Anthropic exercises its two 5-year extensions. Now, Anthropic, the company behind the Claude AI assistant, they are aggressively securing their future compute needs, and they are clearly willing to pay top dollar to guarantee they have the infrastructure to scale up. It's a huge commitment.
But keep in mind, this isn't just an overnight flip of a switch. We are looking at a massive 3-year phased rollout down at Riot's Rockdale, Texas campus. The first 96 megawatts won't even come online until December 2027, and the rest is slated for June 2028. So what does that mean for us? It means full revenue realization is literally years away. Riot is going to need incredible patience and pretty much flawless execution in the meantime.
Ultimately, Riot is serving up 191 megawatts of computing capacity. To put that sheer amount of power into perspective, that's enough to run roughly 150,000 homes. And Anthropic is paying a serious premium here, about $2.4 million per megawatt in annual rent. But here is the real kicker, the part that makes this so insanely attractive for Riot. Management is projecting an incredible 80 to 90% net operating income margin on this deal. I mean, that kind of high-margin, contracted recurring revenue, that is exactly the kind of stuff Wall Street absolutely drools over.
So the obvious question is, can Riot actually afford to make this massive pivot? Let's jump into Section 2, unpacking Q2 financial results and looking past those headline losses.
Okay, on the surface, I'll admit the financials look pretty messy right now. Even though revenue actually beat estimates, coming in at $174.2 million, up 14% year over year, by the way. There's this giant $237.2 million net loss sitting there, and that definitely raises some eyebrows, especially when you contrast it with the massive $219.5 million profit they posted in the exact same quarter last year. Quite the swing, right?
But hold on, the really crucial point here is that this loss is mostly just accounting noise. It's not some huge operational failure. Actually, over $240 million of that loss was from non-cash items, mostly Bitcoin mark-to-market losses and depreciation. When you strip all that noise away and look at the core business, their new data center revenue practically exploded, jumping 400% from Q1 to reach $23.2 million. And that includes $4.9 million in recurring operating lease revenue. So it proves this whole new business line is already starting to get some real traction.
Plus, Riot is sitting on a massive survival runway. They finished the quarter with a cool $1.2 billion in total liquidity. That's split between $666 million in Bitcoin and $549 million in pure cash. Honestly, this gives them an incredibly robust balance sheet. It's exactly what they need to kickstart this highly capital-intensive AI build-out without immediately slamming into a financial brick wall.
Now, unsurprisingly, Wall Street had a whole lot to say about this structural shift. Let's check out Section 3, Market Reaction and Analyst Views. High conviction, wide spread.
Spoiler alert, the market loved it. The stock jumped from $19.40 to well over $24 in after-hours trading, sending analysts scrambling to update their models. Right now, we're looking at a consensus of 12 buys, 8 holds, and 3 sells. But look at those price targets. There's a huge volatile spread here. We're talking anywhere from a low of $17 all the way up to a high of $40. This incredibly wide gap tells us one thing for sure. This is a high conviction but high risk story, and the experts are heavily divided on whether Riot can actually nail this execution timeline.
But amidst all these upgrades, we absolutely have to talk about this contrarian warning. One analyst specifically flagged that Riot looks pricey on sales. And they've got a point. Right now, Riot is trading at a price-to-sales ratio of 11.2 times. When you stack that up against the industry average of just 3.8, well, the math doesn't lie. You are paying a huge premium today for growth and revenue that, frankly, hasn't actually materialized yet. So, to really understand why this valuation premium exists, let's zoom out to Section 4, the AI infrastructure boom, a global megatrend.
Because look, Riot isn't operating in a vacuum here. The AI inferencing boom, which is basically where these massive language models are actually put to work, it requires a literally unimaginable amount of compute power. Just look at these multi-billion-dollar mega deals happening all around us. You've got Anthropic doing a $10 billion deal with Volta Infra, and Elon Musk's xAI signing a mind-blowing $45 billion deal. Infrastructure is clearly the ultimate bottleneck right now. I mean, even Singapore-listed data center REITs posted a solid 5.74% gain in Q2, leading their entire sector. The overarching global thesis is super simple. AI needs power, and power needs highly specialized infrastructure.
But let's bring this back down to a grounded reality for a second in Section 5, major risks and headwinds. Essentially, what could go wrong? Well, the most glaring risk by far is this massive operational shift. Think about it, running a volatile, decentralized Bitcoin mining setup where you can just switch off the machines if power gets too pricey, that is a completely different ballgame than managing contracted, enterprise-grade AI data centers. Enterprise clients, especially heavyweights like Anthropic, they demand continuous, near-perfect uptime and meticulous facility management. It's like comparing apples to, well, a supercomputer. It requires a completely different operational DNA.
And then, add on top of that a brutal $2.1 to $2.3 billion capex estimate for construction. Guys, that's actually higher than Riot's entire current market cap. Plus, remember that 3-year wait for full revenue delivery we talked about? Yeah. And to make things even more tense, Riot is currently leaning on a $573 million bridge facility from Morgan Stanley. So they have massive pressure on them right now to secure permanent, investment-grade debt to actually fund this whole shebang. If financing costs suddenly spike, those beautiful 80 to 90% projected margins are going to take a major hit. Long story short, this stock is currently priced for absolute perfection, and their margin for error is razor thin. So as an investor, how in the world do you navigate this high-risk, high-reward story? Let's move to our final section, number 6, key milestones to watch and building your watch list. All right, here is your exact step-by-step watch list for the next 12 to 18 months. First up, you've got to monitor their upcoming Q3 2026 earnings, specifically looking for updates on their financing terms. We need to know, can they actually lock in favorable debt to protect those target margins? Second, keep a very close eye on the construction progress at the Rockdale campus. Literally any slip in that timeline is probably going to severely punish the stock. And finally, don't forget that Bitcoin still makes up over a third of their total liquidity. So you absolutely have to watch broader AI sector spending alongside legacy Bitcoin price action because both of those are going to heavily dictate the health of their balance sheet during this entire multi-year transition.
Ultimately, this explainer highlights how Riot is trying to pull off a massive transformation, pivoting from a highly speculative Bitcoin play into a stable, contracted enterprise AI infrastructure asset. It's a bold move, but with billions in capital on the line and 3 long years until full revenue realization, the execution mountain they have to climb is incredibly steep. So, I'm genuinely curious to know what you think. When you weigh that massive potential upside against the undeniable, very real operational risks, are you bullish or bearish on their ability to pull this off? Take these insights, definitely continue your own research, and we'll see you in the next explainer.